Let me ask you something honest. When you sit in front of the charts, is it really the market you're fighting, or is it yourself? You've studied technical analysis, you understand structure, you know risk-reward ratios, you've watched hundreds of hours of trading content, you've backtested strategies, and yet, consistency still feels just out of reach. You hesitate after losses, you exit winners too early, you move stops when price gets close, you overtrade after a red day, and afterward you tell yourself, I know better than this. So why does it keep happening? Because trading is not a technical game, it is a psychological exposure. The market exposes every weakness in your thinking, every need, every insecurity, every illusion of control. The charts don't test your intelligence, they test your emotional stability under uncertainty, and that is where most traders collapse. The core problem: your brain was not built for trading. Your brain evolved to survive physical danger. If something causes pain, your nervous system labels it as a threat. In the wild, that kept you alive. In the market, it makes you irrational. A losing trade triggers the same survival response as real danger. Your heart rate increases, your body tightens, your mind searches for control. But there is no control. There is only probability, and your brain hates probability. It wants certainty. It wants guarantees. It wants to know what happens next. But the market does not offer that. It offers uncertainty, structured uncertainty, but uncertainty nonetheless. The trader who succeeds is not the one who predicts best. It is the one who tolerates uncertainty without emotional collapse. That is a psychological skill, and like any skill, it must be built deliberately. Let's break down the deeper mental shifts required. 1. Stop trading outcomes. Start trading process. Most traders measure success by results. Did I win? Did I lose? How much did I make? Professionals measure something different. Did I execute correctly? This is a massive shift. If you judge yourself by outcomes, you become emotionally reactive. If you judge yourself by process, you become stable. Here's the truth most people resist. You can execute perfectly and lose. You can execute poorly and win. If you celebrate bad execution just because it made money, you are reinforcing future inconsistency. The professional mindset separates outcome from behavior. The only thing you truly control is execution. Entry quality, position size, risk definition, rule adherence. That's it. Once the trade is live, control is gone. Trying to control what happens next creates anxiety. Anxiety leads to interference. Interference destroys edge. So professionals detach from the outcome and obsess over the process, because over time, good process produces stable results, not immediately, but statistically, and statistics do not care about your emotions. 2. Think in series, not moments. Here's a dangerous illusion. This trade matters. No, it doesn't. Not individually. If one trade can emotionally destabilize you, your position size is too big, financially or psychologically. A professional understands this. Any single trade is just one data point in a long series. Imagine flipping a biased coin that wins 60% of the time. If it lands tails 3 times in a row, does that mean the edge disappeared? No, it means randomness expressed itself temporarily. But traders don't treat their systems like probabilities. They treat them like predictions. When you expect certainty from probability, you experience emotional shock. When you expect variance, you experience stability. The edge plays out over 30 trades, 50 trades, 100 trades. If you are emotionally reacting to trade number 3, you are not thinking in distributions, you are thinking in moments, and moments are deceptive. Professionals zoom out mentally. They operate with statistical patience. They know streaks happen. They know drawdowns happen. They know confidence must come from testing, not recent results. That long-term lens protects them from emotional turbulence. 3. The need to be right is destroying you. This is uncomfortable. Most traders are not attached to money. They are attached to being right. When a trade wins, it feels validating. When it loses, it feels personal. But the market is not judging you. It is not rewarding your intelligence. It is not punishing your mistakes. It is simply moving based on collective behavior. If your ego is tied to your trades, you will hold losers to avoid admitting you're wrong. You will cut winners early to lock in being right. You will argue with price action, and price action always wins. Professionals detach identity from performance. They do not see losses as evidence of incompetence. They see them as business expenses. Every business has costs. A restaurant pays rent, a factory pays labor, a trader pays losses. If you cannot emotionally treat losses as operational expenses, you will always trade defensively, and defensive trading is inconsistent trading. Detachment is freedom. When you no longer need to be right, you can simply follow rules, and rule following is where consistency lives. 4. Fear means you haven't accepted the risk. Let's define something clearly. Fear in trading is not weakness, it is information. It tells you one thing: you are risking more than you are comfortable losing. Acceptance is not logical, it is emotional. You can say, I risk 1% per trade. But if that 1% loss ruins your mood, you have not accepted it. True risk acceptance feels neutral. If the stop hits, you feel nothing dramatic. No anger, no revenge, no urgency to recover, just data. Before entering a trade, professionals mentally rehearse the loss. They visualize the stop getting hit, and they ask, am I completely okay with this? If not, they reduce size. Fear disappears when risk is aligned with emotional tolerance, and when fear disappears, execution becomes mechanical, calm, precise, professional. 5. Discipline is an identity, not an effort. Most traders rely on motivation. They feel disciplined after watching a trading video. They feel focused after journaling, but emotion fades, and when emotion fades, discipline collapses. Professionals don't rely on mood, they rely on identity. They see themselves as consistent operators. Breaking rules feels unnatural to them, not because they force themselves, but because it contradicts who they believe they are. Identity drives behavior automatically. If you identify as someone trying to be disciplined, you will constantly struggle. If you identify as a disciplined trader, behavior follows naturally. This shift is subtle but powerful. You are not trying to follow your system. You are the type of person who follows systems. That identity reduces internal conflict, and when internal conflict reduces, execution stabilizes. 6. Trust is built through testing, not hope. Many traders don't trust their strategy because they never tested it deeply. They rely on recent wins for confidence, and recent wins are fragile. Professionals build trust through evidence. They backtest, they forward test, they collect data. So when drawdowns happen, they don't panic. They recognize variance. Without data, you are trading hope. With data, you are trading probability. Hope creates anxiety. Probability creates calm. If you don't trust your system statistically, you will always interfere with it emotionally, and interference destroys performance. The final reality: the market is not your enemy. Uncertainty is not your enemy. Your unmanaged reactions are. Professional trading is emotional regulation under pressure. It is patience when bored. It is calm when losing. It is restraint when winning. It is executing without needing immediate reward. That is maturity. And maturity compounds. The market will always be uncertain. That will never change. But you can become stable inside uncertainty. And when you do, you stop fighting, you stop chasing, you stop proving, you start operating consistently, rationally, professionally. The real edge is not your entry, it is your psychological stability. Build that, and everything else aligns.